to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey everyone, welcome back to the Daily Gold Podcast. With me today, one of my favorites, one of your favorites. He's Vince Lanci. He is with Echo Bay Futures. He writes the GoldFix on Substack. He is also a professor at UConn who just won the NCAA championship. I'm sure, Vince, you had a lot to do with that NCAA championship in basketball. But Professor Vinny, we are here because I have you at the end of every month, or we can wrap up every month.
Yeah.
And thank you so much for joining us.
No,
And
I look forward to these. These are great. These are end of the month things are really good for us to do. I'm happy to do them.
Do you want me to go right into my analysis of the end of the month?
Yeah.
Or I'll do
let's do that. Let's do that. We'll branch off. Let's start with the end of the month. I mean, I'll do
a bit of play-by-play and a little analysis with that. But the play-by-play is gold and silver. It appeared before the last week in April they were setting up for a really strong month, but they gave back a lot of those gains. And so if you're looking at the monthly candles in gold and silver, yes, they finished the month higher, but they formed inverted hammers on the charts, on the candle charts, which is just another way of saying they went up a lot during the month, but then they failed to hold most of those gains. So it's not bullish. It can be bearish, but you don't necessarily want to read too much into that. But here's my analysis with that, Vince. Well, there's two things. First of all, silver did close above the monthly breakout point by not a huge amount, not a considerable amount, but it did hold that breakout, at least on the monthly chart. It did hold that breakout by around a point, I think. So you do still have that silver breakout on the monthly chart. Now, the other thing is gold against the 60-40. And we're going to be, as we're speaking here and the viewers are seeing this, you're going to be seeing the chart. But Vince, this is a chart where, I've drawn a red line based on the last couple of years of gold against the 60-40 because gold has been bumping up to this level. It's been struggling to break above it. And if we see gold going above this level, and holding it, that could be like a new secular bull market signal for gold. Right. And so the end of the month selling in gold prevented that from happening. So middle of April, as we got to April 20th, and gold was setting up for this secular confirmation breakout against the 60-40 portfolio. But then as gold and silver lost their gains into the end of the month, we didn't get that 60-40 signal, gold breaking out against the 60-40. So it's still below it. So that's some bit of color commentary to go with the play-by-play at the end of the month for gold and silver.
Okay, so where would you like me to start? The inverted hammer, the ugly inverted hammer. No, I mean, look, I was excited. I'm like, look at this. This was me the week before. Just I'm giving you my emotions describing what you just said. I was like, oh, we have a week left. Look at this. This is going to be a great monthly close. This is amazing. Now, I didn't look at the 60-40, but I'm looking at it now because of this conversation. And then we had that last week, and I went, that's shitty. And then the end of the month candle came. And I'm preparing for our conversation. I go, well, it's a long wick above, and I hate those. And that's inverted hammer, hanging man, however you want to look at it, tombstone. But it looks bad. But at least it's a new all-time high close, on the gold futures as well as the gold spot. And then this month starts. A couple of days go by this month, and it starts to get hammered more, and it's still green, but the open interest is going up as it's going down. But I don't want to get off on that tangent yet. But I want to go back to the 60-40 portfolio. First of all, before looking at the actual lines as a technician, some people would say, what do those two things have to do with each other? Well, these are the kind of technical analysis charts that you want to look at. I would look at things like, gold versus bonds and copper, and what have you. But a 60-40 versus gold is a tremendous relationship. And here's what I mean. Technical levels are, if they're done right, if you're looking at the right technical levels, you're looking at the fingerprints of behavioral patterns by investors. And, what better behavioral pattern to look at than how most people put their money and what they put it in when they're not putting it in those things. So most investment firms have their money in 60-40, 60-40 portfolio, 60% stocks, 40% bonds. Now, gold is the alternative to that. It's the inverse beta, it's the reverse correlation, it's the hedge for everything, it's the imperfect hedge for everything. But instead of looking at gold versus stocks, which is important to look at as well, or gold versus bonds, looking at gold versus the 60-40 will give you the fingerprint or the footprint, however you want to look at it, of the behavior of big money managers, especially United States ones. So when you look at that chart and you see that despite gold being at 2,300, right? Despite bonds being in the crapper, right? Bonds are getting shit on, right? This thing still hasn't broken out. And that's because of stocks. So people are still putting their money into stocks, which brings me to that whole red line you drew there. That red line behaviorally is, if all the investment firms say we're going to have stagflation, which is a possibility now, then that line is going to be broken by gold rallying, stocks dropping, and bonds dropping. If we go from, instead of a stagflationary environment to a recession, that line can be broken, meaning stocks will drop, gold will be stable or rally, and bonds will rally. So bonds may rescue it. So that line to me is the stagflationary line. Anything below that line, for the most part, is either recession, gold will do fine relative to stocks, but probably not relative to bonds, right? No landing. Well, no landing, everything goes up, but maybe stocks outperform. Okay. No landing could be bullish for gold compared to that 60-40 portfolio if bonds get crapped on again. And then the third scenario is soft landing. And in soft landing, we don't break that line. So in soft landing, you have stocks going up, bonds recovering, and gold maybe doing okay, but certainly not like stocks. So I like that chart, particularly because if I see that line that you drew broken, in combination with some definite stagflationary news, well, then we're off to the races, I think. And it's very possible that the miners are conveying that a little bit. So yeah, I like that chart a lot.
Right. And I'll just throw in there, the confirmation historically. I mean, the people viewing this on YouTube, they can see, I mean, the lines that I've drawn, we had confirmation in 1972 and 2002 based on how the ratio moved of new secular trends there. And that's basically, we have not got that for gold. Yes, gold has broken out. So in nominal terms, it's clearly in a new secular bull market, breaking out of that cup and handle. But to me, I mean, my analysis is this is really the last thing. Like, if we're going to see gold go to 3,000 and 4,000 in the next couple of years, which I think it can do and will do, this is the last signal, in my opinion, that we really need, because, but and this is what you're saying. That's how you get those increased capital flows. We're not going to see gold go to 3,000 with the stock market at all-time highs.
Right,
like, it's
right.
Just
the government doesn't care about gold at all-time highs as long as stocks are making new all-time highs. And portfolio managers will not put their money in gold in a big way until gold's outperforming stocks, regrettably, but that's how it works. You're right.
Yeah. And I have to say, I'm a bit surprised, because in the last, couple years, I was just like banging my fist and banging the drum on, you're not going to see gold break out until the stock market cracks. Well, I was wrong about that, because we did get the big breakout, and
Right.
the stock market has not cracked yet. So
Right.
But that being said, I firmly believe we're not going to see gold at 3,000 if you have the stock market at it's going to have to crack
Right.
for
No,
gold to
it's
get
right.
there.
It's right. In fact, I mean, that makes a lot of sense. I mean, I would have said, well, look, I mean, if you were to tell me, right, we're going to have a war in the Middle East, a war in Europe, a debt problem, right? And you were to say to me, and gold to be trading 2,300, and then you were to ask me, well, where will stocks be? And I'll say, well, they're going to be in shit land, but they're not, right? It's almost like, and when I say almost, I mean that in quotes, because I mean, it is like, uh, uh, as long as stocks keep going up, as long as the Fed can preserve the stock market, as long as the Fed put exists, then they're going to be okay with gold making new highs. That's historically how it works. So to your point, I mean, who would have thought stocks would be up here given the news? Look at the news. Yeah, gold's up. That makes sense. Oh, stocks are up too. That doesn't make sense. So it has the stock market has become, and this is not a hyperinflationary comment, but it is related. Uh, Stock market has become money, meaning the currency, the currency of second to last choice after money, after fiat money, is stocks. I'll put my money in Apple. If we have inflation, Apple will go up because it'll keep pace with inflation. Not necessarily Apple, but you get my point. If we have recession, I'll get a dividend. And if we have, and I'll buy some bonds, that's 60-40, right? And if we have,
Soft
uh,
landing or no
a soft
landing.
landing, right? Soft landing, stocks are the way to go. So, 3 out of 4 scenarios or 2 out of 3 scenarios, uh, that's why 60-40 money goes, I'm putting all my money in stocks and then I'll put some of it in bonds, right? 60-40, 65-35, that's it. But the monthly close was the best of all time, but it had an anchor around its neck, or an albatross or something. It's looked bad since then. And I have my concerns about the market with, I think there's $300 of downside. And I'm not calling for that, but my portfolio represents that. I'm short call spreads in gold again, and I'm long miners. I'm short the call spreads in gold against being long miners because now they're finally in the money for me. I don't own them for 10 years. I own them for 3 months when Druckenmiller bought. And so I don't want to sell the miners out. I want to sell bullion because bullion's come a long way. And I think both can go down, but gold can drop more relative to miners. I think people are taking their profits in gold and putting it into miners now. It's interesting.
Okay, yeah. So let's build on that a little bit, especially on the gold side. I think we can get to miners after that, but on the gold side, um, your analysis is you see that you see some near term or medium term downside potential in gold, and that that can align with the technicals and these inverted hammers on the monthly closes. And also, I throw in there because I did say, and I think our last pod or the one before that, yeah, the negative scenario would be you get a retest of 2,100 in gold. So I'm not putting words in your mouth. I'm just saying, I'm just giving you some technical ammunition if you want to be bearish, but of course, you don't base everything on technical. So you have that, and then let's hear your analysis why you think at least this correction, gold, be it in price or time, has more to go.
Right. Okay. So before I go through my little, it's a macro story, right? Before I do that, look at the head and shoulders, the cup and handle. We can pull back all the way to the lip, and things are fine. I'm not saying I'd be
Yeah,
happy
totally.
if that happened, right? I'm not saying
Yeah.
that I'd be happy if that happened, but it takes a lot to kill this market now. As you said several times, this is one for the ages. Would you say they'll be putting in technical analysis books eventually, and they will. Just hope it's because the market keeps going up. But yeah, I mean, a $200 pullback is not crazy, and it's consistent with what I've seen in the macro discretionary money piling into this market. So, which brings us to the why I'm bearish or why I'm not bullish. And it's easy to, it's like, oh, the market's a little bit lower, so he's getting all bearish. No, no. I've missed the last $150 of this rally in gold by buying miners. I'm like, oh, gold's overvalued, but Druckenmiller bought miners, so I'll buy miners. I understand miners enough to know that I don't know enough. But so I've missed this rally. So it's not like I'm getting bearish because we had a bad week. Just understand that. A couple things happened last week, not 2 weeks ago, last week, that make me more reticent to buy dips. First of all, I like to talk secular, big picture, mercantilism, things like that. And those are all real, the BRICS, that's all real. It's not going away. You're not going to fix the world overnight after sanctioning and then taking Russia's money and repurposing it. You can't fix the broken trust overnight. So those secular forces aren't going away without a war. The micro forces are the things that we see day to day, and the micro forces look constructive. I'm not going to get into that right now, but the macro forces, the in the middle, right? That's the macro used to be the big picture. Well, the big picture is the big picture now, the stuff that I like to talk about. The macro is, macroeconomic analysis is about policy by the government. It's about domestic behavior, and it's about financial correlations. And for me, it's also about how these things will influence the players in the market. So now that I've gotten that preamble out of the way, in early April, there was a buyer that came in. Let me see if I can find it. There was a buyer that came in. I'm not going to throw the chart up. I just want to have it handy. I identified a big buyer on April 5th. This is after the macro discretionary guys got in. Now, I didn't know who this buyer is. I still don't know, but this buyer drove the market up. And I drew a line, and I said, okay, let's see how it acts when it gets back there. And then, fast forwarding to April 23rd, we tested that area. And the area was, using spot, the area was around 2301. All right, 2301 to 2305. And the market went back there, and we left that nice long wick on the daily, and I went, oh, the guy's still there. I was encouraged. I was like, okay, this is cool, right? And then the market kind of rallied a little bit, and then we had that big down day on the 30th, the day that almost destroyed our monthly candle, right? One of the 2 days, but that was a big day. But it stopped in that area, not exactly at that price, but in that area. It made a new low, and then the next day came right back up. And for the next 3 or 4 days, this market has stayed in my zone, meaning the buyer comes in at 2301, and he's going to be a buyer down to 2285 on my system, referring to futures, not spot. And sure enough, that's happened. It's happened 4 days in a row, basically, right? It happened on the 30th. We closed down there. The 1st, we opened there and rallied all day. The 2nd, we tested it, finished weak, but tested it and closed above it. And on Friday, which was essentially a doji day, right? We tested it in both directions. Now, from a macro point of view, that's not macro. I'm describing technicals and flows. But from a macro point of view, Friday was extremely important for me with these levels. The first thing is, when the FOMC was announced, now here's the meat of what I'm talking about. When the FOMC was announced, Powell said he's not cutting. That's bearish, right? But then Powell said he's going to reduce QT. So he's not cutting, but he's kind of cutting. All right. So it's on average, it's slightly dovish. Stocks rallied, gold rallied, and then faded. That was on the FOMC. And I'm like, oh shit, stocks are outperforming gold again on dovish news. That's not good, especially after all this other stuff. And so my conclusion was, before Friday, my conclusion was the shorts are going to start getting confident again, and they're going to test this buyer, whoever he is, in that area. And sure enough, on Friday, right, non-farm payrolls come out, and non-farm payrolls are very weak, right? Stocks rally, gold knee-jerks higher to like 23.20 in spot, and then stocks stabilize and then keep rallying, and gold gets smacked down violently. That's where we had that doji day, violently down to roughly around 2285 again. And then it finishes at 2300. So what I'm getting at is, when the gold market is not in control by the longs, it will pin strikes. And now we're at 2300 again. And I'm looking at this market, I'm saying, I don't care what the strike is, 22, 19, 18, 15, 1200. If we hover around a strike and we stay there, that's the bullion banks getting confident. Bullion banks are short options. Bullion banks are short metal. Bullion banks are going to lean on the market to hopefully force, this is part of their playing, not accusing of manipulation. They're going to force the longs to start to get impatient. And what I'm saying is the macroeconomic backdrop has given a little bit of confidence back to the bullion shorts. I'm saying this to you as a bullion type of short player. I would be like, you know what? Data came out, gold didn't really do anything on Friday, right? Gold was weak on Friday, right? The FOMC happened, gold was weak. All of this looks like the macro discretionary guys, as profitable as they are running out of money to add. And if they're running out of money to add, step one for the bullion banks is to keep it near a strike. Step two is to spoof it or hammer it lower on bearish news and see how far they can knock it down. So between now and CPI, I'm neutral and bearish. CPI will tell me if we're in a stagflationary environment, which would break your red line, right? Or if we're not, which would keep gold crapping out a little bit more. So that's my story. I think that the secular tailwinds that are pushing gold up are running into their first resistance, and that's the macroeconomic environment is going to start pushing back and giving the bullion banks a little bit of confidence to the shorts, the bears, to lean into it and to test the resilience of the macroeconomic longs. That's my story.
Okay, let me just a follow-up question on that.
Sure.
Because I think the last time we talked, you basically said, the bullion banks and their cronies, they're getting ready for the market to rise. Like they see what's coming. They're going to come out with all these new products to monetize it.
Yeah.
Is this just they see the market, they know what's going to happen long term, but they see the market right now and think, yeah, we can push this thing, lower for, a couple months or into the summer and, just kind of cool off the market for a while. Is that fair to say? Or, I mean, because I think that would still align with, what you talked about in the last podcast we did.
Well, yeah, I mean, there's a little bit of tactical stuff going in there. This is my opinion and it's speculation, but I've seen it before. Of the bullion banks that play, most of them, as I said before, and as you reminded me, have gotten the picture. And the picture is start creating products, start recommending the metal, and you have clients that want to be long, so you may as well start recommending it. But within that cohort of bullion banks, I'm very confident that one of them got really caught short and got hurt. Now, I'm not saying bullion banks are going to blow up. I'm not saying that. I'm saying that there are, 5, 10 bullion banks that actually play. And in that group, there are traders, and those traders have habits. Those habits are, I like to play from the short side because of this, this, and this. And one of these traders didn't get the memo. And I think one of these traders has been the short covering, I have a chart on that, has been the short covering rally at these levels. Nobody is short this market on the fund side at 2,300. But the banks are, and we had a nice short covering rally between the end of March and the first week in April. And I think a bullion bank got stopped out. So what I'm trying to tie together is in general, the bullion banks are preparing for the new product, the new market. It's not going away. They like it. But within that cohort, there's always one guy late to the party. There's always one guy who's going to miss the musical chair, music stopping, and that guy got taken out on a stretcher. Now, is the bank going under? No, the bank's not going under. I'm saying the trader is going under. I would not be surprised to see a bullion bank trader at one of the banks, I'm not going to say any names, but get fired. Right? That's what happens. The bank doesn't go under. The trader gets fired. The position gets covered, and they move on. And I think the position got covered between April 5th and April 12th. I think that was the position getting covered, and that's when the BIS came in. So anyway, so what I'm saying is that as a product, gold is hot, and they want to be involved. Okay, right? So within the bullion banks, one of them got hurt. Now we come to what you're saying. They would love this market to go sideways or lower for a while, not because they hate it, but these guys, they love to play from the short side, right? Open interest goes down to 420, they get long. Open interest goes up to 500, they get short, and they're basically trading the oscillation of open interest. But now open interest is 500, 500, 500, and they can't get their shorts back. They would love for this market to just go sideways for a couple of weeks so they can get some shorts back. And I believe that that's what they're looking at. They're looking at fundamentally, the gold market is here, and it will be even more here if that little red line you drew is broken. But tactically, they need to catch their breath. These guys are, some of them are making money, but I think a couple are losing money. And they're losing money because they didn't prepare for this properly. They put a junior trader on there. But, long story short, the secular picture is there. The bullion banks at the research level, at the marketing level, at every level of these banks, they're saying, well, we've got to talk about gold now. And the traders are like, oh, shit, I'm still playing from the short side. So there is a little bit of a lag, I think, from the trading desk to the fundamentals of this. I hope that answers your question.
No, that's great. That makes a lot of sense. So, yeah, just to repeat what you said, the trading desk, there's a huge lag there, and those guys are so far behind that they were still playing the market from the short side, even after gold breaking above 2,100.
Yeah, habits die hard, right? I always make money buying calls. And then we get into a bear market and the calls don't work. And I keep buying them because we're creatures of habit. And habits are hard to break.
Yeah, no, I was discussing this in a couple other interviews, like the regime change. It's like people are so slow. Gold with the real interest rates, like in the last year, I mean, how many times you'd see these reports where people would say, oh, well, look at real interest rates. Look at the 10-year bond. Gold should be at 1,200. It's like, hello, guys. The market is telling you something. Like, how many times, how long is this going to go on for? But yeah.
Right. Exactly. That's a great example. The correlations, and I've written on that extensively. In fact, I wrote on it again very recently. The correlations that a neo-Keynesian economist would look at would say, well, gold's priced in dollars, it will go down. It will converge. Real yields are competing with the ownership of gold. It will go down. Well, that's true. That's true when the market is secularly stable. That's true when all the world is on the same playing field. That's true when everyone's using dollars to buy their things, but they're not now. And so correlations still matter, but they matter at different levels. Maybe you should be looking at, you should be looking at gold versus the Chinese government bond, the CGB, gold versus the yuan. Why? Because it's the Chinese that are buying it. Why are they buying gold? Well, look at their bond yields. Their bond yields are dropping. Bond yields matter, just not American bond yields right now. So yeah, that's the point. People stick, old dog, new tricks type of thing. And there's a lag. We all do it. We're all a little bit slow on that. And that's part of what makes you a good or a great trader. Anyway, that's it. It's the correlation is a great example of what I'm talking about. They're not getting the message.
Now, the other follow-up I wanted to ask you about, but I think you answered, because I think you mentioned a while or a little while, and I was thinking, like, is he talking about like a month or two, or could this be like 4 or 5 months? But I think you mentioned like a couple weeks. So your analysis here, I mean, is this just like for the spring? Is that the potential time frame?
Oh, yeah, that's fair enough. My next, what do you want to call it? Mile marker, my next signpost is 2 weeks from now when CPI comes out. Okay. So if CPI comes out, it's like the Groundhog Day. If CPI comes out strong and stocks sell off and gold rallies, then I'll say we're off to the races, right? Especially on your 60-40 ratio. I'll say we're off to the races, and I'll be like, okay, the sell-off might just be over, right? Or the lull, let's call it a lull. The lull might be over. If CPI comes out, continue like low again, then I'm going to say, all right, well, we could be in for another 2 months of winter. And then I'll say, and then when that happens, if that were to happen, then I will start to seriously consider seasonality. So we're in the spring. Spring to summer is generally good for gold historically, from say April to August. But I'm not counting on that. I would be looking at if CPI comes out soft, and the Fed's not going to ease, and stocks rally and gold doesn't, well, then I would say, well, we could be in for another 2 weeks of winter. I'm not sure. CPI can come out really hot and hit gold. CPI can come out really soft and hit gold, and vice versa. It depends on where the market is, how they're positioned on stocks right now. So if the market looks at CPI as stagflationary, right? Everything else in the economy is weak. Inflation is hot. The Fed can't do anything. Stagflation. And gold rallies. That's great. If everybody looks at CPI being hot and says, oh, the Fed's going to ease again. I don't know why they think this, but, oh, the Fed's going to ease. Well, then you could see gold and stocks rally, which would keep your chart below the red line, right? So stagflationary makes gold go up, and the new era start, right? The new red line era start. But a hot CPI that can be translated as the Fed's going to ease is going to drive stocks up more than gold. So I guess what I'm getting at is 2 weeks from now, I reassess. And that reassessment will be, do I think we're done and we have upside to go? Or do I think we're running into a stagnation area between now and October? So that's the bigger thing. So I guess what I'm looking at is I'm cautiously bearish, but I'm not getting short in my mind or in reality until this market cracks. I'll use futures. I'll use spot until this market cracks and stays below on a weekly basis 2281. If it closes on a weekly basis in spot below 2281, then I think we've got a problem. And if that happens after a CPI number, then I think we've got a multi-month problem. That's it. That's where I am.
And what would that number be in futures?
Let me see. All right. The range was the range for the buyer that I haven't identified, but I know he's out there, was 230460 to the bottom of the wick on April 5th, which was 2286.20. Okay? If we close on a weekly basis below 2286.20, then I think we're in for 2 more months of winter. Does that make sense?
Yes.
That's it. Then I will seriously consider getting short, which is, ridiculous. Oh, Vince wants to sell it in the hole.
Yeah.
He wants to sell weakness. Yeah, that's what I do, right? I sell weakness and I stop myself out tightly because I like to trade momentum. Do I like to buy dips? Yeah, I like to buy dips, especially after a long wick like that, which is why I'm not short. Half of me wants to buy this dip. The other half of me says, you've got to be nuts. I think the bullion banks are going to test this buyer in the 2285 area, and they're going to crack it. And options are telling me that as well. By the way, just as an aside, Macro discretionary guys love options. They love to buy calls, and they drive the volatility up and the skew up. When the market goes sideways, they start by selling their calls, and I'm seeing the volatility creep in. And the volatility creeping in is like them saying, I'm not so sure, So if they start to throw in the towel, you might see a snowball effect, especially below 22.8620. What are your levels?
Well, I've been focused on the 50-day moving average, which on futures right now is at 22.44, and also there's an open gap down to, I believe it's 22. Maybe it's 22.20. Because I've been looking at 22.40. Let's see. Okay, yeah, no, that's 22.40. Because looking on futures, if you go back to March, we had a bit of a consolidation. Then the market had one gap up, but it wasn't a breakout. So there is an open gap at 21.93 down to 21.75. So that's one potential 21.75 to 21.93. So that gap is on, let's see here. That is the gap from March 26th.
Okay. So
you have 21.75 to 21.93. And so the market gapped. It had a shitty close that day, but then it really took off after, like it was straight up after that, all the way to 2,400, basically.
Right.
Now there's another gap. So that could be the breakaway gap potentially, although it was a weak close. And then you have this open gap down to basically 22.40. I mean, you actually have a couple gaps there, but you do have basically an open gap down to 22.40. So I've been eyeing that for a long time. And in addition to that, you have the 50-day moving average, which is now above the gap at 22.44. Now, the reason the 50-day moving average is important is because I'm looking at bull markets in gold, and I've looked at, okay, when gold has a pullback, when it's in an impulsive advance, it has a pullback. Where does it usually bottom? It usually bottoms around the 50-day if it's really hot. If not, then the 100-day or the 150-day. Now, based on what you're saying, and also me looking at this chart, I don't think this is going to bottom at the 50-day just because it's at 22.44 and it's continuing to rise. Like this is rising 5 points a day. And then you have that open gap down to, again, 22.40. And you look at the 100-day, the 100-day right now is at 21.41. So like people need to understand, gold has corrected now over $100. Got up to 24.50. It closed at 23.09 futures.
Right.
But it is still a huge distance above all these moving averages. Right. So like it's almost like, I mean, what you're saying is very important, but I mean, kind of, if I could, parse what you're saying, at least kind of align it with my technical terms, is gold going to correct down to the 50-day bottom and stabilize there, possibly fill that gap at 22.40? It's going to stabilize it, eventually turn back up, or are we going to see more of a correction where it's going to come down to, at least 2,200 and maybe fill that gap down to 21.75. Right. And, it could test the 100-day or go a little bit below it in a month or two. So I know I'm just babbling on, but I think those are those are the two scenarios I think are most plausible for me over the next 2 months.
This is helpful because I'm going to share a trade that I'm looking at now based on this conversation. All right. Now, I believe there's a buyer between 22.85 and 23.05, and that person is discretionary, take their time, but they're big. I believe, as I said, if we close a week below 22.8620, that will go down. Well, guess what my target is? My target now is the 50-day moving average. So between 22.44 and 22.40, where the gap is, that's my trade. So I'm giving you a trade. The trade is if we close, this is what I'm going to do. If we close, other things could change, but this is pretty much what I want to do. If we close below 22.8620 on a weekly basis, then I will get short looking for a target of 22.44. Now I may buy it before then at 22.54, but the point is I believe that if we break that buying level, your 50-day moving average becomes a magnet. right? The market will search for the next level of buying. And that next level of buying is probably, as you're saying, in the 2240 area where this gap is. And then probably the next level of buying underneath that is 21, for me, 2190, and then 2150, and then 2120. So I'm looking at this market saying, hey, shit, we're in a bull market and I see $50 of downside here, right? I love doing that. I love finding that. Now to bring it back home from the bullish perspective, we've, like, as you said, we've already had $100 off the highs, 100, 150 off the highs.
And we're still way above. I mean, we're even right now, we're still $60, $65 above the 50-day moving average.
Right. And I think there's going to be a magnet there, but by no means am I saying we're going to go up. But this is why I think the bullion banks are looking at this the same way you are. They're going like this. They're going, we cracked it. We got it down. The data's looking bad. The stock market's holding and gold's not. Let's lean on it. What's our target? 50-day moving average. Let's see who needs it. Like that's what they're looking at. They're looking at that. But there's a buyer, and that buyer is 2286.20. Now, I'm going to put a trade on this, and I'm not sure what it'll be. It might be selling call spread. It might be buying a put spread. It might just be selling gold. But the reality of it is, when people give you advice, they say, oh, on a weekly basis. Well, what happens if it happens on a Monday next week? Well, that's the problem, and you have to figure out how many contracts you want to do. This is a little tactical advice. So let's say I want to do 5 units or something. Well, if we're below 2286 on a Monday, the moment we go below there, I'm going to sell 1, right? And every day that we're below it, I'm going to sell 1 more for 5 days. This way, if the market is above it, I don't participate. If the market is below it, I do. God forbid we go to 2285 on Monday, and by Friday we're trading 2240, and I'm waiting for a weekly close. So tactically speaking, I will average into a short position on every day we're below 2286 next week. That's it. I think this is a good trade.
Now, I guess this could be the last thing we talk about, because I want to make this, well, not more confusing, but I mean, I love intermarket analysis.
Yeah.
Okay, so silver had the breakout above 26, and the 2 levels I was looking, if you could pull up silver while I'm talking here.
I'm looking at it, yeah.
If you look at silver, I mean, silver's open gap, I think, was like from 25.92 right up to 26.30. And so silver came down, and we got a bullish hammer on Friday. Like, we actually got a bullish hammer on the daily chart, if you saw that.
Right.
It bottomed right at the top of the gap. So silver comes down, it bottoms right at the top of the gap. If gold didn't have another $60 of downside, in my opinion, I would think, hey, that could be like the correction low for silver in terms of this.
Right,
like, we could have seen the price low.
The way things are going now, Jordan, it could be the low in silver and not the low in gold. You know what I mean?
Yeah, and because, sorry to cut you off, because the other thing I wanted to add, which we mentioned at the beginning, the miners, the stocks are acting a lot better than gold. Like, if you look at, you can't always go by looks. I mean, someone told me that once,
Right.
which, I could make a tranny joke is in there somewhere. You get the idea.
Well, look, if she's not good looking, maybe as long as she cooks.
Yeah.
I know the women are going to be upset at that. I'm just making an old Sinatra type joke. Anyway, go ahead.
But no, because I'm looking at GDX, GDXJ, SILJ, and the price action. Just look, these are way above their 50-day moving average, but they've already bounced off support twice. And yeah, these could consolidate for another month or two, but looking at these charts, like they're holding up better than gold. They definitely are. And so you factor that in along with, what I just said about silver. And it's really interesting because, the question is, well, is gold going to drag all these things lower, or are all these things telling you that, hey, maybe gold is not going to go that much lower? Maybe it's maybe it's what you're talking about where, the CPI comes out and then the market suddenly decides, okay, it's stagflation now. And then we get, in the next month, we're breaking out of the, past the 60-40.
Yeah. I mean, look, my trade on gold aside, looking at the silver chart and looking at your level. Well, I look at your level, your gap, and I say, well, why can't we fill the gap? And as long as we stay above the December 4th open, which was 25.94. That's silver futures. As long as we stay above that, then silver's a buy. So gold can drop $50, $75. Silver can remain above that. They could both leave long wicks and go back up. So, maybe silver is a dip to buy. Maybe silver is something to buy on a dip. But yeah, it's all fair game now. We have dynamic markets. Correlations even between silver and gold are no longer robust. So yeah, I mean, put it this way. If you're a gold bull, let silver be your guide. Unless silver gets below that gap, you're okay long gold. That's crazy. I don't like to do that anymore because of the way gold and silver have been acting, but it's certainly one way to look at it.
Yeah, I would be more concerned about gold if the miners and silver weren't holding up.
Yeah.
So well, I mean, miners especially. I'd be more concerned about downside in gold. Because just looking at, well, I'm sorry, you go ahead.
No, I wanted to add I wanted to talk about the miners for a second. Last month, a couple of months ago, I said they're going to start rotating out of the macro discretionary. They're going to start taking profits in gold and punting a little bit in silver. And that's what got silver going. Okay. And that worked. Okay. They sold a little gold. They bought some silver, and that worked. Now they're selling a little gold, buying a little miners, and that's also working. So that's why miners, if we have a stagflationary environment, gold will do better than miners. But if we have a recession with the anticipation of the Fed easing, then miners might do better than gold this time. So what I'm saying is I'm long miners. I'm short gold call spreads. And I think I might, on the next dip, a sell-off in gold could be a buying opportunity in miners. That's what I'm saying. That's it.
Right. And what you said about recession and stagflation is correct fundamentally, because in a recession, that's when miners, you get the best leverage because the costs come down, they get hit hard, but gold is the first to move. So gold shoots up when the costs are still down. And that's why you see those vertical moves in the miners against gold when you're, in a recession or towards the end of it. Yeah, I think I had another thought in there, but I think I lost it.
You were talking, I interrupted you. You were talking about gold's not such a sale because the miners are so well.
It popped back. It popped back in my head. Maybe and I don't want to sound like I'm reading into it too much, but the way this is looking so far with how the miners are acting, this is kind of classic early bull market action where gold has gold makes a big move, it breaks out, and then you have the first correction. Yeah. And in that correction, the miners, they tend to hold up really well. And even the juniors, like the quality juniors, you would think they're going to be, down, 20 or 30%. And yeah, there's some that are, not super high quality that are down 20%, but the high quality ones, like they're yawning at this. They're not really doing any, cause I remember in 2009, we had that huge move in gold to 1,000 in 4 months, right? It peaked in early Feb 2009. Right. And then gold consolidated for 4 or 5 months. But the miners and the juniors, they kept moving. I'm not saying they skyrocketed, but they made higher highs before gold broke above 1,000. Yeah. And if you go,
this is your 60-40 portfolio. See, the guys with money in stocks are going, well, geez, I have to have some gold exposure. Well, bullion's moved too much. I'll just buy some miners. And that's how it starts. You're right.
And I was going to say the same thing happened in the early 2000s. Like, I know this is pre-gold ETFs, but 2001, 2002, the miners had moved so much. Even, gold was only up like 50 or $70, and the miners were already up, 200, 300%. So again, I don't know if I'm reading into it too much, but this looks to me like classic early bull market action. When you have the first correction in gold and the miners, they don't correct as much as you would normally expect. And that's the regime change. We were taught, the old habits die hard. That's because people, they were so slow. They didn't buy the miners. They didn't get it on the breakout. But then it's usually the second move. And then you get the miners really outperforming and you get silver really outperforming.
Well, something I want to say about the miners in general uh, that relates to what you're saying. Back then, as you were saying, there were no ETFs, and
Right.
so the miners got overbought. Right? You can make that case because there really weren't too many equity side things for them to go into. Well, now you've got GLD and SLV, and so that has contributed substantially to the lack of investment in miners. If you want Bullion exposure, buy GLD, right? And that has contributed to basically the mining depression. And like any trade that gets crowded, the mining short trade is now crowded. I'm sure there are players out there that are short miners and long bullion. I'm sure. I mean, it's going to happen. You're going to see an unwind like that, and it's going to be brutal. So I
No,
agree with you. The increased ETFs has depressed miners, at least in part.
yeah, it's
but
no,
that trade is that
it's
trade's
just, sorry to cut you off. Yeah, no, it's depressed the valuations. Like if you look, it depends what you're looking at, but if you're looking at price to cash flow, they're the two things that hurt mine. Like everybody's like miners suck, that Hugh Hendry was like tweeting about it, and it's like, yeah, okay, master of the obvious. Like this would have been, this tell me something 12 years, like tell me this 12 years ago or
yeah
10 years ago. Don't tell me now.
yeah
But
yeah
there's two reasons why. It's the introduction of all the gold ETFs in 2006 and the silver ETF whenever that came about. And then secondly,
right
you're in a secular bull market for precious metals since
right
2011. You had
yeah
gold, it was a double whammy because you had gold had 12 or 13 years where it basically you had no progress on the price, and silver was down 50%. And think of how much costs have gone up in the last decade. It's the same thing with the last 3.5 years. And
right.
I'm sorry, I'm getting off on a tangent, but it's not as complicated as people make it out to be. It was a double whammy for the miners. You
Yeah,
had the ETFs, and then you had the secular bear market in precious metals that fucking killed miners in their valuations.
that's
But
right.
now, if we're in a new secular bull for gold, and you look at what happened with crypto and all these shit coins and Twitter and communications. I mean, you get gold moving to 3,000, 4,000, you're in stagflation, and there's going to be speculation in the miners, in the juniors. I'm not
There
saying it's going to
is.
happen tomorrow or next month, but it's it could be setting up for that.
There is. I mean, there is. Um, the I mean, the only thing to add to that is the miners are not going to get overbought this time before the metal because, well, I mean, in the 70s, the miners led because, as you noted, there was nothing else to put your money in. But energy costs were lower then. Like, didn't miners rally before energy spiked? You know what I mean? In other words, this time we have inflation and everything but gold. Well, now we have
Yeah,
gold higher,
yeah.
but the costs are going up now. Anyway, that's cool.
All right. Any other comments before we wrap this up? Anything else
No,
we need to touch
nothing
on?
to add except that I'm bearish for $40 uh uh below 2286. But I'll tell you, I will look at silver. If I were to sell gold at 2285 to simplify it, looking for 2240, 2244 area. If I see silver acting good in that area, for some reason, if silver's
Okay.
unchanged while gold's crapping out, I'm probably not going to, stay short long in gold. So that's my takeaway from this conversation today.
Yeah, gun to my head, I still think silver will fill that gap down. I think it's 25.92. And I think
Yeah,
you mentioned, I think you said that'll probably fill.
yeah.
But you look at the last couple daily candles, and yeah, I think that's important to watch if you're watching the market,
Well, that's the thing,
how silver
like
acts.
the gold market. I've been saying someone is testing that buying, but and it's getting weaker and weaker slowly, right? In silver, they keep testing that buy and it keeps just rejecting it, right? You see those long wicks, those long wicks. So it almost feels like there's more buying in silver than there is in gold right now. Who knows?
All right, very good. Vince, before we close, please tell our listeners where they can go to subscribe to GoldFix.
Sure. GoldFix is VBL GoldFix. It's a Substack site. So V Victor Boy Larry GoldFix. You can sign up for free, and we'll be happy to send you posts and ask you to upgrade to premium. That's apparently how the system works. Or you can sign up for premium, and I'll give Jordan a 30% off for annual memberships if you'd like to try it out. We have a lot of research from institutions on precious metals and inflation and macroeconomics, and insights from myself and people that I speak with, and some news related to the markets that's hopefully very helpful. So yeah, thank you very much.
All righty. Sounds good. Everybody check it out and subscribe. And Vince, we'll talk again roughly a month from now. Yeah.
Hopefully it holds 2240. Anyway.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.